Hello learners, welcome to our session today. I'm your instructor, CPA Aringo Frederick. So in our class today, we are going to introduce a very important concept, that is a variance analysis. And this concept will assist any student doing management accounting. Section 2, Section 5, those who are doing F5 or F2 in ACCA, this concept is going to assist all of you. So basically, looking at variance analysis, before we start looking at this concept, I want us to approach it with an open mind. Let us approach it with a mind of understanding the whole idea behind variance and also the main concept that you must always grasp. We should not have a mind that variance is all about cramming formulas. That will mess you big up. This class of ours will not be using acronyms to assist you probably understand the concept. That is purely cramming, of which in our case we won't be using any form of acronyms to assist you, maybe a form of cramming the formulas. No, that is not our idea. Our main idea is for you to grasp the concept so that even you can go and probably guide your fellow students. So, approaching this concept, let us have an open mind. A mind that we should understand the whole concept behind variance analysis. So, to start with variance analysis, you'll find that at this point I'm having two words. We do have the aspect of variance and I'm having the aspect of analysis taken separately. So basically, it will be upon us to understand the concept of variance. Then later on, the process of analyzing these variances or the differences is sort of determining it as what? The aspect of variance analysis. So giving you the concept behind the variance, first of all, I want us to have that concept right. Whenever I'm talking of variance, just the same as I'll be looking at a form of a difference. Difference between what? I believe by now we have done the aspect of budgeting. So I'll just be looking between the difference between the budgeted data and the aspect of the actual data. That is what will give us variance. So you're saying that at this point I'll be looking at the difference between our budgeted data. I'll be looking at the difference between our budget, because that is what you're timing it as standard, and what? And actual. So the difference that I'll be having here, this is what we'll be having it as what? As variance. So that is what you're looking at it as variance. Even look at your day-to-day activities. Maybe on aspect of probably purchasing an item. Maybe you've budgeted to purchase an item at a certain amount, but going to the market, you find it at a whole different amount. So at the same, on that concept, you'll find that you will be having what? You'll be having a variance. Take a very good example of what is happening now. We are in a crisis, and in this time, we have solutions probably that will assist us to mitigate or to reduce the spread of this virus. So you'll find that most of the business now probably they are engaging in either on production of sanitizers, or even you as an individual probably you are encouraged at least to have sanitizers every now and then. So you'll find that looking at this illustration, you have probably while you are maybe at your place, probably at least you are budgeting to go and purchase sanitizer. So that in this case, your budget of purchase of sanitizer, maybe you had budgeted, you told yourself that in the event that I've gone to the market, I'll purchase sanitizer at a figure of 200 shillings. That is what you've budgeted. But going to the market, actually this time you are looking at cost, right? You are looking at cost because you are purchasing. Going to the market, the actual amount probably because your bargaining power is very high, you bargain till to the point that you purchase it at 150 shillings. And remember, what was your budget? Your budget was 200 shillings. But going to the market, you bargain and you purchased it at how much? At 150 shillings. At this point, you'll find that I'll be having a difference of how much? A difference of 50 shillings. Now, the question will be, this difference, relating it now with the concept that you are doing today. This difference is what I'm going to term it as what? As variance. This is the difference I'm going to term it as a variance. Then I'll be explaining this concept right now. Again, that is one scenario. Another scenario, probably, you had budgeted the 200 shillings, but going to the market, the actual figures are totally different. Maybe you find it at 300 shillings minimum. But what had you budgeted? You had budgeted 200 shillings to purchase sanitizer. So you'll find that at this point around, I'll be having what? I'll be having 100 shillings. So these differences are what you are going to term them as what? As variance. But what you'll note is that in the first scenario, you'll find that whatever that I had budgeted, I'm spending less than what I had budgeted. I'm spending less than what I had budgeted. And in spending less than what I had budgeted, at the same time as you are looking at it as variance analysis, you'll find that this point or this time round, this difference that you are talking about, the difference that you are talking about, I'll be having as a variance that has favored me. This difference has favored me because it as if I'm saving. And if I'm saving, you'll find that such a case, I'm going to term that variance as what? Favorable variance. Favorable variance. Favorable variance. Favorable variance. So are you terming it as a favorable variance because I'm spending less. This is cost. I'm incurring less than what I had budgeted. And such a variance, in that case, you'll find that I'm having what? I'm having a favorable variance. Now, look at the second scenario whereby I had budgeted to spend 200 shillings. The actual amount that I'm spending 300 shillings. So, I'm spending more than what I had budgeted. I'm spending more than what I had budgeted. That is still a variance. But this variance is against me. This variance is against me because I'm incurring more than what I had budgeted. So such a case, we'll find that whenever I'll be having such a variance, I'm going to term it as what? Adverse variance. The variance that is against us, you are going to term it as adverse variance. The variance that is in favor of us, we've termed it as favorable variance, as we have clearly illustrated it at that point. That is one scenario. Remember that point you're looking at what? We were looking at cost. We were looking at cost. Assuming this time round, maybe we are talking of revenue. Talk of budgeted. Talk of budgeted. And you are talking of what? You are talking of actual. This time round, you are looking at what? Revenue. You are talking of revenue. You are looking at your revenue. Now you are a seller this time. Remember the first scenario, you are looking at if you're a buyer. Right now you are a seller. Maybe you had budgeted to sell that product or that sanitizer. You had budgeted to sell that sanitizer at 300 shillings. Going to the market, probably your client has a very high bargaining power. Maybe you end up selling it at how much? At 250 shillings. You'd be having a variance of, yes, 50. This is revenue, right? Or about another scenario, the same case, maybe you had budgeted at 300, going to the market, you sell it at 400 shillings. You have a variance of 100 shillings. Remember, this is revenue, what you are earning. You had budgeted to earn 300, but you're earning 250, meaning that you are earning less than what you had budgeted. So such a case, that should give us a variance that is against me because I'm receiving less than what I had anticipated. So in such an event, I'll be having what is known as what? Adverse variance, because I'm looking at revenue. What about this case? On aspect of revenue, I'd budgeted to receive 300, but I'm ending up receiving 400. So that I'm receiving higher than what I had budgeted. So in such a case, we'll find that I'll be having a variance, yes, but this variance, I'm going to have what? A favorable variance. I'm going to have a favorable variance. I'm going to have a favorable variance. So by now, my good student, what you should notice is that whenever I'll be talking of variance, I'll be looking at it into two perspectives. That is the aspect of favorable variance and the aspect of adverse variance. And as we have clearly illustrated it at this point. Now, the process by which we will be analyzing these differences. The process by which we will be analyzing the differences. That is what we'll be terming it as what? As now variance analysis. The process of us analyzing the differences is what we are going to term it as what? As variance analysis. And ideally, that's the main concept behind variance analysis. You'll find that on aspect of revenue, whenever you're talking of a bit of variance, they behave opposite with what? With the cost. Will behave opposite with the cost. Now, after we have clearly gone through the concept of variance analysis, comfortably, we can now define variance just by using the same concept that we've given. By using the same concept that we've given, we can clearly say what variance is. We can clearly state what variance is. So, looking at that case, I'll now want us to define the term variance. I'll want us to define the term variance. And I know just by the look at the concept, you can clearly define for me what variance is. You can clearly define for me what variance is by just the look of the concept that we've just tackled right now, the aspect of variance. So maybe to assist you quickly, we can mention, or we normally say that variance is the difference between a planned. Variance is the difference between a planned talk of standard or budgeted planned talk of a difference between a planned, standard, or budgeted cost and the actual cost, in CAD. So that is a very good definition of what variance is. So you normally say that the same comparison can be made on revenues. The same comparison can be made on revenues. The same comparison, of course, may be made for revenues. Can or may be made for revenues. May be made for revenues. So basically, that is what you're terming it as what? As variance. Now, what about the aspect of variance analysis? We've looked at that concept. Now, what about variance analysis? Whenever we'll be talking of variance analysis, what will ring at the back of our mind? Variance analysis. So basically, that is also simple because I'll just be looking at what? The process by which we analyze the differences between the standard and actual. That is what you're terming it as what? As variance analysis. So, variance analysis, we say that this is a process by which this is the process by which the standard, this is the process by which the differences between, this is the process by which the differences between, this is the process by which the differences between, or the differences between standard data, standard, and actual results, and actual results is analyzed. So that is what you're terming it as. So that is what you're terming it as variance analysis. As simple as that. As simple as that. So you just be looking at, now to this point, we've looked at two main concepts. To that point, we've looked at two main concepts. That is the aspect of variance. We've looked at variance analysis, and ideally the whole concept of favorable and adverse variances. Now, at least we've made two steps in understanding the concept of variance analysis. Now, the next step is for us to understand how variances are grouped. So we normally say that variances are basically grouped into 5 main categories, and you are going to use a chart to explain that. So that should take us to group of variances. So we normally say that variances are grouped into 5 main categories, and this is what we have. So allow me to erase here. So now, whenever we be talking of variances, we are saying that variances are grouped into 5 main categories. So whenever we be talking of variance, we are going to look at it into 5 main categories. You are going to look at it into 5 main categories. So talk of variance analysis. We are saying that that one is grouped into 5 main categories. So looking at variance analysis, I'll be looking at it at this point. So we can have a form of a chart. That is our variance analysis. Our variance analysis, you are saying it is grouped into 5 main categories. So we have category number 1. Category number 1, we are going to term that as what? We are going to term this as material variances. We are going to term them as material variances. That is our category number 1. Category number 2, we'll be looking at labor variances. That is category number 2. Category number 3, which in that case we've classified, actually I've just divided them at once. We'll be looking at the aspect of overhead variances. But overhead variances is categorized into 2. So we are saying 5 because we've broken this aspect of overhead variances into 2 categories. That is the aspect of variable overhead variances, and the aspect of fixed OHD variances, fixed overhead variances, category number 4. But basically the two, all these are what? Are overhead variances. All these are overhead variances. Then of course category number 5, we'll be talking of what is known as what? Sales variances. We'll be talking of what is known as the aspect of sales variances. So these are 5 main categories of variance, basic variances. So later on you'll find that again this one is going to be broken into 2 parts. Basic variances. This one is going to be we are going to look at it into 2 perspectives. Again, this one into 2 perspectives, and also the same case into 2 main types of variances. Where on this category number 1, we'll be looking at it as aspect of material price variance, and we'll be looking at it on aspect of material usage variance. Remember, we are going to look at this deeply, so this is just a matter of you understanding it well. labor variances, I'll be looking at it into two perspectives. That is aspect of labor rate variance and labor efficiency variance. Then look at it on aspect of variable overheads. I'll be looking at it into two perspectives. That is the aspect of variable overhead expenditure variance, and also we'll be talking of what is known as what? Variable overhead efficiency variance. That is under variable overhead. The same case under fixed overhead variance, I'll be looking at it into two: fixed overhead expenditure variance and fixed overhead volume variance. Fixed overhead expenditure and fixed overhead volume variance. So remember, you're just breaking them into two. So going further, we are going to look at this sales variance into two, where we'll be talking of sales price variance and we'll be talking of what? Sales volume variance. Sales volume variance. Sales volume variance. So you'll find that this chart actually, it has summarized all types of basic variances that we need to know at this point. So later on, we'll be breaking usage, efficiency, and probably aspect of efficiency variable to further probably for us to understand it well later on. So this is a structure of variance analysis. So in my next session, my good students, I want us to meet and look at each and every component individually. We are going to look at material variances. We look at the main two, same way with labor, variable, fixed, and what? Sales variances. So to this juncture, I wish you to join me in the next session where we are going to look at this variance separately. Thank you so much for being with me in this session. So let us meet in the next session for us to elaborate more of these variances. Thank you so much.